All right, we're back in this time with the data Dr. Wizard. What we're going to, psychologist.
Well, yeah, there's a bit of everything in there.
That's what we're going to unpack today.
Jack
we're
of
gonna,
all trades.
Jack of all trades, master of none, yet alone he's got a doctorate in front of his title. And we are going to unpack human behavior when it comes to property and a lot of biases from the 1960s and 1980s of land size, land to asset ratio, buying 10 kilometers into a capital city, property doubles every 7 to 10 years. And of course, to kickstart the conversation welcome Matt.
Thank you, Ollie. Thanks for inviting me, man. It's always a pleasure to see you.
I'm going to kickstart you with a word that you live and breathe with 24/7 and will die by. The data-driven way of investing, the data-driven buyer's advocate.
Yeah.
Let's unpack first and foremost, what is data-driven investing?
Yeah, like everything, I'm a bit of a contrarian in a sense that, I live by data and data-driven investing, but only if it's done so in the right context of understanding, So what is data-driven investing? Well, you're looking at property investment indicators to try and to determine, how areas will behave in the future, short-term, long-term, mid-term, essentially, trying to invest. So you're looking at data points, you're triangulating. That's what I call it, triangulating. It comes from the academic background. You're triangulating to find the best, spot. Now, I think that term has been substantially overused, and I would say especially by buyer's agents, because somehow, and I don't know how this happened, the banner of I'm a data-driven buyer's agent has attained this, mystique or like an aura of competence for some reason,
Or validation of the industry.
Well, validate, whatever it is. Like as soon as you say, yeah, that's right. When you say I'm a data-driven buyer's agent, that means, okay, I'll give you my money. Here you go. And now, when it comes to data analysis, I don't even know what that means, being a data-driven buyer's agent. But when it comes to data analysis, it's extremely complex. And I deal with buyer's agents on a regular basis. Some connect the dots very fast and are very good at it. Some not so much, which is fine. We're all at different, journeys of growth. But I do think it is an overused term and a misunderstood one for a variety of reasons.
I guess there's two parts to it, right? Is there, given that it's so widely used at the moment, in the right way, in the wrong way, time will tell, is there an over-reliance on data that will trip an investor or a buyer's agent or a professional buyer in their investment journey?
The answer is no. So, however, it has to be used correctly, I'm not going to try to dismantle an atomic bomb because I don't know how to do it, So, essentially, it's the same with data. So, first and foremost, we have to understand that data equals behaviour, and I always say this. If I go every morning to the closest McDonald's to order a medium long black with 2 extra shots, and on the 4th morning, Google Maps will tell me that I've got 3 minutes to my destination. Okay, what do Google Maps do? He collected the patterns of my behavior and projected what is going to happen in the future, okay? It is the same with data. Every purchase that we make, every preference that we have related to property gets recorded as some form of a metric, So therefore, data is the record of human behavior, okay? And if you use it in the right way, you can then ascertain what might happen next in the same way, you use Google Maps. Now, over-reliance on data, I don't think that exists because we have to understand that economies, governments, big companies, Fortune 500s, they all use data to actually understand markets, internal organizational behavior, everything under the sun in order to understand how to operate within those markets. So you can't have an over-reliance on data, but what you can do is you can develop a paralysis analysis from using data if you don't use it in the structured way, in a way that it should be used. And I think the way it should be used is that, as we mentioned before, we have to understand that there is an inherent hierarchy in data. in information. Some information is more valuable for me than others. And in the context of investing, some information is more valuable than the other because I have different, briefs or purchase requirements. So we need to understand this hierarchy and of information in response to what we are trying to achieve, and we need to apply that hierarchy accordingly in order to use the data in the right way.
Property myth one, the property market has grown exponentially over the past 2 years. It's too late to enter the market. And I think this is where the next point being is this is a blind spot in the data-driven approach of knowing what data point to pick that is relevant to an investment brief, an investment journey, from one person to the next to the other, where the over-reliance on data sets can be somewhat overwhelming to any investor, any professional. It's being able to triangulate, is being able to order a level of hierarchy, an order of importance that is addressing an investment thesis, an investment strategy to almost complement and provide a conclusive observation.
That's absolutely, and that's why when you get printed out reports from wherever, and there's so much information in a report, you have to think about how a human thinks essentially. Like, what do I look at first? Why is this here? Why is this important for me? And all of these other things, So that needs to be arranged in an appropriate manner. And going back to data and over reliance on data, I usually hear this misconception about data, and I'll come back to the hierarchy. I usually hear this misconception about data where people say, I use data, but then there are boots on the ground.
Yep.
So that's the usual dichotomy that I get. I use data, but then there's boots on the ground, and I'm like, okay.
Or, Matt, let alone, I use data to then validate boots on the ground, that the data is what we're seeing, or a reflection of boots on the ground.
Well, that second one is more sensible to me. You know that the data is a reflection of boots on the ground, so you're trying to validate it, But when they dichotomize, data and boots on the ground, it tells me that they don't know what data means.
Yep.
Okay? So, boots on the ground, again, you're going around, you're going around the suburb and looking at all the trees and, all the parks and everything like that, and you're trying to, look at the appeal of the area. Well, if I want to look at the appeal of the area, I'll just look at the socioeconomic index of the area and I'll know the appeal. I know what I'm dealing with, So, and there's many other different things, what I mean? Which streets are better? There are better streets within, within suburbs. You can again see that from different hexagons that we have on the map and understand, okay, this is a better location. There's more renters than owner occupiers here. There's more. So, from example, renter to owner ratio. Let's say within one hexagon or one street, you have a very high proportion of renters. I can tell you how that street is going to look.
Yep.
Or at least I can tell you it's not going to look like a street that's dominated by owner occupiers,
Yeah.
So bottom line is, this dichotomy between boots on the ground and data I completely disagree with. And there's also the tendency for people to say, I use data, but data goes so much, and then I use, planning and zoning and all of these other things. And then I'm like, okay, but isn't planning and zoning information, and therefore it's data? Bottom line is what people don't understand is that everything that can be recorded forms a data point.
No different to comparable sales. That's a data point in RP data.
Exactly.
Which you then triangulate to come up with fair and reasonable
price. And then you can do that in various ways. Let's say we draw on construction. How much is the cost of this additional toilet?
Yep.
And there's two comparables that we're looking at: 1312, 1322. And then you sort of formulate, and then you can formulate the additional cost of the toilet, but then you also have to consider the market momentum to see whether it's just a cost add-on, or is the market momentum going to carry it further and it's going to overshoot the price anyway. And you can do that from supply and demand, essentially.
Absolutely. Which then goes back to my next point is, let's face it, the data-driven concept of the 21st century way of investing is going to be how we invest over the next 10, 20 odd years, with the addition of AI, with the addition of all things that complement it across. What is that biggest unseen cost that we're now seeing potential investors getting wrong when it comes down to suburb analytics?
Well, many. Again, how long do we have? The first one would be that not understanding the hierarchy of information, then focus on a single negative, and there are like 30 positives about the suburb.
Yep.
And our mind has the tendency to do that. We try, because I guess we're outlaying, $500,000 to $1 million. We try to focus on a negative that has no relevance in the context of what we are trying to do. So I think that's one of the things that people do wrong. The other thing would be also to not understand, how your brief impacts, what you're trying to choose and what carries significance. The third thing that's emerging recently is the AI, like for example, the low-hanging fruit of paying, $20 for a ChatGPT subscription and then putting in, which areas to invest in. Interestingly, 2 days ago, an article came out, was written by Mike Mortlock. You know Mike Mortlock?
Yes.
Yeah. About how much, ChatGPT was actually wrong in the suggestions that he was making. Now, not to go into detail, large language models can't predict from information that's online, So you need trend analysis, you need volume, you need 5 decades of data to extrapolate what's going to happen in the future. So those are the dangers as well. They're trying to rely on a narrow data set, on something that doesn't have that depth and trends, so you can project and foresee what's going to happen in the future. Focusing on a single negative when there are many other positives about the area. And then finally, obviously, not determining what is really important for what you're trying to achieve. Your timeframes, your goals, your equity extraction timeframes, risk profiles, all these other things that we talk about every day.
I'm going to throw you one challenge, and a very hard challenge, right? There are so many data points that's available these days. You have one choice. What is the single most important data point?
I hate that question.
You would have. What is that single data point that you would pick, and why?
Yeah, so I'll give you the data point. But just to provide context, you need a single thing can't tell a full story. And we have to understand that perfection doesn't exist. If perfection doesn't exist in anything, in any domain of life, my burger is not going to taste perfectly, in any domain of life, perfection doesn't exist, especially when it comes to suburbs. And because perfection doesn't exist, that requires you to look at many different data points and vantage points to eliminate risk. Because, again, perfection doesn't exist. So I'm a big, I'm in favor of really trying to layer the information to get a better view of what you're looking at. But if I had to pick a data point, I think because of the, economic structure of Australia and what is happening, even around the world as well, I think the middle class is being essentially evaporated. I think the affordability is one of the most important questions that we have to consider. The affordability of that asset within an area, because that drives purchasing patterns. I always say, I moved to Australia in 2010. Sorry, 2000, not 2010. In 2000, I remember I used to fill up a shopping trolley with $20. Now it takes me 300. So I might go to Aldi, and by the way, Aldi entered the Australian market as a low-cost alternative, to Coles and Woolies. They actually created a revenue-generating stream. So bottom line, what I'm trying to say is that purchasing patterns alter when you can't afford something, so you deviate from things. And this is especially important in the context of property, because it's the biggest outlay that you're ever going to make. The fact that the difference between wage growth and property price growth, and the gap has been the biggest since 1970, I think that one of the most important things that drives purchasing patterns is, to me it's common sense, but can I afford this property? So I would say the affordability index on HTAG is one of the primary things that I would look at. But again, a caveat is I would never stop there. If I stop there, I'm not doing an analysis, I'm just playing.
And what is so unique? Let's unpack affordability index, right? In the context of HTAG's metric. what is the unique spin that you guys have taken on the affordability index?
Yeah, so it's an amalgam of a couple of things. So it is a median price of medium income of residents that live within that suburb. It includes the typical price. It includes a consideration that 50% of mortgage repayments are going towards 50% of the medium incomes are going towards mortgage repayments on an 80/20 LVR. Yep. And it takes into account the current cash rate, so not the interest rate, the cash rate, RBA cash rate plus 2% buffer. So in my view, it's like a mortgage stress indicator, you know. It's the closest thing to understanding, you know, how capable are people of actually purchasing a property, and the way we express it is as years to own, i.e. how many years does it take for a medium income household within that suburb to actually pay off a mortgage within that suburb, you know. And that's why it's expressed as a number, as years to own, 30, 25, 80, 70, you know,
Yeah. So quite an easy metric to unpack and understand, but a very important metric. Is it fair to say the years to own can then be added to age of purchase and then adding on another 30, 35 years to own?
Okay, so age of purchase of the individual?
Correct.
No, and I'll tell you why. Because you are looking at the aggregate representation of movements. That's the suburb level. Yes, I can be... See, this is... And it's linked to medium incomes. You know, medium incomes in that suburb, i.e. the purchasing power, not to the age. So let's say... you know, I'm 17 and I'm purchasing property, you know, I have more room to go. And let's say my income is in line with medium incomes. That actually doesn't matter how old I am. What matters is how will other people be buying property and whether they can afford it in that suburb to actually push the price up. I need other active buyers, other individuals competing for the same asset, having the ability to afford that property in order for my property to grow in value. So we need to be competing for the same asset. I might be 17, somebody might be 35. So it's not related back to the age of the individual. It's related back to the medium income or the purchasing power of residents within that suburb on an aggregated level.
Awesome.
Yeah.
Very well unpacked in terms of how the years to own is triangulated back onto everyday practice. Now, moving on to our next question, a very interesting one which affects how data points are selected and the metric and how data points are selected, but also the level of importance that's given to it. The challenge that a lot of investors face is defining an investment timeframe horizon. And we all know it can be anywhere from 3 years, 5 years, 7, 10, 15, 20. What's your view on the ability to accurately define an investment timeframe?
Yeah, so that comes back to personal circumstance of what you're trying to do. I used to live by the rule of never sell an asset. And I'm talking about myself personally, okay? That doesn't mean that I will not come into a situation where I have to sell something, but I live by that rule, never sell an asset. Why do I live by that rule? Well, simply because if I sell it, I have to pay capital gains tax, but if I refinance, I'm not going to pay tax on that money, and I can purchase additional property. You know, finance 101, you know? Now, you could have a circumstance where you want to pay down your PPOR, you know? Principal price of residence, and you want to do it in a short time frame. You want to do it within the next 5 years for whatever reason. So you're looking for those growth locations that are going to pump, if I'm going to use a crypto analogy, and you want to sell, absorb the capital gains tax, pay down your PPOR. That can happen. Or you might have a very short-term investment time horizon where you want to, like 3 years, when you want to increase your capital base, i.e. you want to leverage the hotspot, You want to leverage, let's say, people who bought in 2021 in Perth still realised 80 or 90% gains within 3 years. So they had a lot to play with, and they can sell down, enlarge their capital base so they can leverage into more additional assets. Yes, they pay capital gains tax. Bottom line is, what I'm trying to say is there are multiple variations when it comes to determining the investment time horizon, but it all comes down to what you're actually trying to do. Your investment time horizon is going to be 1 year if you're renovating, or 6 months. And then you're going to look at different things within that area. So if you're trying to make money from renovations, from flipping, that's the flipping strategy, But if you're, like myself, I have a long-term investment time horizon. I think I'm going to live until 255, and I just want to leverage the compounding aspect of it. It's always 10 years plus, 15 years, or as long as I can hold it, because what I'm trying to do is I want to be in a situation where I use a single asset multiple times to leverage into additional purchases. So I want to refinance that asset multiple times, once, twice, 3 times. The better you do the analysis, when it comes to the long-term prospect of the area, the more opportunity you will have to, leverage into additional assets at multiple times and refinance. So, it comes back to personal circumstance.
I think then leveraging back into this notion of investment timeframe horizon, no different to paying down your PPOR, but the flip side of building your deposit to purchase a PPOR. And the notion of a hotspot or warm spot then adds the relevance into that investment timeframe horizon.
Absolutely.
Where one particular strategy could be buying 2 or 3 hotspots and leveraging on the short-term aggressive deposit build-up, and then slowly start disposing the assets strategically to achieve that goal.
Yeah, it's even more layered than that. Like, that's one example, but you could have. You need to address 2 aspects of time within a single brief. Okay? So you need to address the short term as well as the long term. You can address only the short term if you really need to sell from a personal circumstance. But if you don't want to sell, if you want to hold it long periods of time, you can still have a short term goal of generating 20 or 30% return within the next 2 years. But you need to also then make sure that the asset that you hold in that area will go through another round of growth or another cycle of growth. Everything moves in cycles. So you'll buy in an area that will deliver 20% in the short term, that will subside, the curve will go down, it will stagnate for 5 years, and then it will go through another round if all of the other aspects are satisfied. So you need to address, both short term, mid term, and long term, like 3 different domains of time, to really be able to leverage that asset into additional purchases.
Property myth 2. When you're at the top of a market cycle, it's too late to enter. And I think that is so well said, because it brings the notion of how can one predict where the market is at the top of a cycle, and is buying at the top of a market cycle a dangerous thing to be doing? Yeah, see,
people go on social media like 15 rounds are arguing about areas, and I said this before, and I don't know why that's so, because if my strategy is to generate 20% return within a short period of time because I want to leverage into additional purchases aggressively, while at the same time satisfying the long-term prospect of that area, you're going to buy at the top of the cycle. Because that's your brief.
Yep.
That's what you're trying to do.
Absolutely right.
This is your brief. And you have to expect that you're going to buy at the top of the cycle or thereabouts. You'll generate 20% in 2 years. You're going to leverage into additional purchases. That growth rate will subside. It will not be 20% anymore. It might come down to, revert to the mean of 3%. It will be there for 4 or 5 years, and then we'll go through another round.
Yep.
But that was your brief. Your brief was, I want to build my portfolio aggressively. So that inadvertently didn't, and this is the thing when people say, we're all looking at the same data, we're buying in the same places. Well, you can't be buying in the same places because your brief might be aggressive portfolio building, which requires you to be put in the top of the cycle in an area. Well, my brief is not that. My brief is I want to sit on the sidelines for 4 years to get that 20%. But the positives of that is that, I enter a market where I can negotiate, source the right asset, etc., etc. So bottom line, entering at the top of the cycle is not a bad thing. First, if it's in alignment with your brief and what you're trying to do. And second, if that area still has steam to go through another cycle of growth. not just, you'll enter at the top, the growth will subside, and then it'll never grow again. That's the danger. That's the dangerous bit. The dangerous bit is another cycle of growth. Is it positive to achieve? Possible, sorry.
Using a couple of key data points with data analysis, what are the key indicators that will allow investors to triangulate and make that conclusion that the market has another growth cycle to go into and has steam to keep going?
Yeah, so first thing that you look at its historical behavior. People always say, history doesn't repeat itself, but it rhymes, So history rhymes. So if you look at 3 or 4 decades worth of data and you see that the area was flat for 2.5 decades, it's a huge question mark.
Yep.
Okay, that it will go through another cycle of growth. So I would downgrade it on my list. But one thing is you have to start with a very high affordability base, i.e. the property needs to be extremely affordable, and yet the area needs to be extremely affluent. If you're pairing those two, it's the golden triangle that you were referring to before. If you combine these two, you're already ticking the boxes when it comes to steam. The next layer would be for me to see what are the long-term indicators. Is there a lot of infrastructure spending in the area? What is the renter-to-owner ratio? Why renter-to-owner ratio? See, a lot of people look at renter-to-owner ratio as a proxy of livability, i.e. the owner-occupier appeal. I look at it as a supply metric.
Yeah.
Why? Because when interest rates start increasing, investors find it difficult to hold on to an asset because their rental increases never keep pace with their mortgage increases. They can start disposing of those assets, increase the supply, and if there's not enough demand, the price drops.
Yep.
So if there's a higher renter-to-owner ratio, long-term concern for me as well, And then again, as I said, you look at the historical behavior, the growth patterns and the curves, and see whether there is this cyclicality that the area has gone throughout the years and it hasn't seen a lot of negative growth in the past, and that's how I sort of arrange them. But the steam element, you have to start with a very affordable area. We have to start with an area that has very high socioeconomics, and then you just observe its behavior in the past. The longer you go in the past, the more information you have. And as long as it hasn't dipped and generated minus negative 20% growth in the past, you're sweet.
So that's where I think that's then starting to give evidence back to the golden triangle, right? Or back to what you and I constantly keep talking about: affordability, sociodynamics, renter to owners, and understanding behaviour of supply and demand imbalance to then start tracking changes across the data set. Because a lot of conversation then comes across the market has grown by way too much over the past 2 years. It's too late to enter the market.
Yeah, that's nonsense. That's nonsense.
Let's unpack that nonsense.
Yeah, that's nonsense. I'll give you an example. There are rules out there floating which say that, if something has grown 50% in 5 years, it means you shouldn't enter. Or if something's grown, 40% in 3 years, it means you shouldn't enter. Well, if that was the case, you wouldn't have entered Townsville 2 years ago and you wouldn't have generated another 40 or 50%. Mm-hmm. Okay? So the saying that just because something has grown, it will not grow more is like saying the sky is blue because it's blue. It's like this circular loop reasoning, So essentially, we have to come down to what growth comes from, and it comes from supply and demand.
Yep.
And if something has grown 50% in 5 years, i.e. Townsville, and if it still has a reducing supply and an increasing demand, it will grow more. Now, you have to determine, obviously, and understand at what point of cycle you're entering into. Is it suitable to your financial circumstance? Does it meet your goals of equity extraction of 2 years because you want to build your portfolio fast? If you don't want to build your portfolio fast and you want to enter early, then you put the Townsville aside. But just saying that because something has grown, it will not grow more is a nonsense. There's many areas. There's Cairns, there's Townsville, there's a lot of areas out there.
WA is another example.
Absolutely. WA is an interesting one because WA before 2020 was stagnating for 15 years, But Townsville has been essentially pumping for the last 8.
Yep.
And if you invested in Bold Plains, to give you an example, in November 2023, and I use this date specifically because I did analysis for clients at that time, they made 60% returns since then. That's life-changing money. They bought 20 assets, buyers agents, within that time frame. So it's a fallacy to assume that lack of growth emerges from growth.
Very well said. And moving down to property myth 3, property doubles every 7 to 10 years.
Well, where?
Australia-wide. That's what our grandparents, our parents have traditionally invested data-driven.
This is actually a complex question, and I'll tell you why it's a complex question. First and foremost, you can see optical growth when it's not actually growth. That's debasement of currency. Mm-hmm. Okay? So what that means is that, it grows because money is being pumped into the economy. If I sell $1 million asset now, I'm not rich. I still have to buy $1 million property next door to live. So I actually didn't make anything, So this doubling effect in some instances happens only optically because the value of money is less, okay? So that's why our grandparents are saying it, but our grandparents are not educated in economics. So putting that aside, some areas double in value, some areas don't. Like, I'll give you an example. In my LGA, Oran Park is seen 150% growth in a decade, while Catherine Fields has seen minus 15.
Yep.
So not every area doubles in value, and assuming that property doubles in value everywhere. And by the way, there is a consensus that there are markets within markets within markets in Australia. So picking the right market, yes, it can double in a decade, absolutely. 7 years is a stretch. It happens rarely. It happens in Townsville, it happens in Perth. But you're sort of treading that line, 10 years is a better sort of benchmark. The fact that something is optically increasing on a chart doesn't mean that it's growing because of demand, but it's just because, the value of money is reduced, and that's the debasement thing. I think Australia's debasing currency by about 7% annually, including CPI. Don't quote me on it, I just looked at it recently, which means that in order for you to make money, you need to make an average growth rate of at least 8% a year. But and then finally, as I said, yes, some areas can double in value, some areas don't. The fact that you're going to buy Newman in WA, you would have seen 80% increase in the last 8 years and minus 30 in the last 10. So essentially an increase and then a dump.
Yep.
Yeah.
And that's where the supply and demand imbalance comes into play. Reducing supply, rising demand, affordability,
crucial indicators.
Comes across to then give a bit of a storyline of property doubling or not doubling across.
Exactly. So there needs to be a narrative behind it. You can't just assume from that statement that it will. Absolutely.
We've unpacked property myths in a very objective manner as opposed to subjective biases.
Well, it's subjective. It's coming from me. So I guess it's subjective.
No, but it was unpacked.
I've been in this for a while. Let's just say that.
And it's been unpacked in a very systematic way with a logic-based framework that goes behind it, as opposed to being one that is just an old wives' tale of how we invest or how we traditionally have invested.
I call that barbecue investing.
The good old barbecue investing.
Yeah, the barbecue investing, yeah.
We've unpacked the old wives' tale, the barbecue type of investing, subjective biases that you probably have heard throughout your journey of investing. And let's hope we have fueled you guys with an evidence objective-based framework where you can battle it out over a sausage snag at your next barbecue. On to the next time. If you want more property myths debunked, drop it in the comments, and Matt and I would basically assist in changing you into the new 21st century investor.